Imagine standing in an ancient marketplace thousands of years ago. Merchants barter under the sun, spices fill the air, and gleaming gold coins pass from hand to hand. For millennia, gold was more than metal. It was memory, a symbol of trust, stability, and permanence in a fragile world. Now fast forward to the 21st century. Markets move in microseconds. Currencies inflate and deflate at the speed of policy. And emerging from the chaos of the digital age comes a new contender, Bitcoin. Some call it digital gold, but is that just marketing or a glimpse into the evolution of money itself? To answer that, we must look deeper, not just at price or technology, but at philosophy. The law of scarcity gold's power has always come from scarcity. It cannot be printed, conjured, or faked. It must be mined, slowly, painfully, from the depths of the earth. That natural limitation gave gold something no decree could replicate: honesty. Bitcoin was built on that same law, but it enforces it through mathematics instead of geology. Only 21 million Bitcoin will ever exist, a number hard-coded into the network's DNA. No government, no bank, no billionaire can inflate that supply. This is not economic theory, it's cryptographic law. While gold depends on nature's scarcity, Bitcoin depends on digital consensus. Its rarity is precise, measurable, and incorruptible. Every 4 years, a built-in event called the halving reduces the rate of new Bitcoin issuance by half. That's not just a technical quirk, it's deliberate discipline. Like digging deeper veins of gold that become harder to reach, Bitcoin's supply tightens over time. Each halving makes it scarcer, stronger, and more resistant to manipulation. Gold's scarcity is found in the earth. Bitcoin's scarcity is written in code. One was discovered, the other was designed. And in a world governed by algorithms and automation, certainty written in math may prove more reliable than scarcity found in stone. Divisibility and portability gold is valuable, but heavy, hard to divide, expensive to store. Imagine trying to buy a coffee with a shaving of gold, or sending it overseas in seconds. It's wealth, but it's slow. Bitcoin, by contrast, is weightless. Each coin divides into 100 million units, called satoshis. You can send a few sats across continents in minutes, without banks, borders, or permission. A traveler centuries ago risked pirates to transport gold across oceans. Today, a traveler can cross borders with millions in Bitcoin, carried not in a vault, but in 12 words of memory. No customs declaration, no confiscation, no physical risk. Gold moves at the pace of ships. Bitcoin moves at the speed of light. And that changes everything. Bitcoin transforms value from something we store to something we flow. A living network of liquidity for a digital world. Trust, broken and rebuilt. To understand Bitcoin's rise, we must understand what it rebelled against. For over a century, fiat currencies, money created by government decree, have ruled the financial world. At first, they were backed by gold. But when the link was cut in the 20th century, money became belief. Paper became policy. Since then, every empire's story has followed the same arc: expansion, debt, and devaluation. From the Weimar Republic's hyperinflation in the 1920s to post-war Britain's currency crises, from Latin America's lost decades to the 2008 global financial meltdown, each collapse told the same truth. When trust is centralized, it eventually breaks. Modern economics accepted inflation as normal, a healthy 2% a year. But that small number hides a slow theft. A dollar from 1970 buys less than 1/5 of what it once did. And no matter how hard people work, their money melts a little faster each decade. Bitcoin was the countermeasure, a protocol that replaced promises with proof and policy with mathematics. It cannot be printed, paused, or politically steered. It offers what fiat never could: trust without trust. When governments print, Bitcoin holds. When banks fail, the network keeps producing blocks every 10 minutes, like a heartbeat that never stops. Transparency and truth gold is tangible, but opaque. You must assay it, weigh it, guard it. It depends on trust. In vaults, in custodians, in the purity of its form. Bitcoin needs none of that. Its blockchain, a public ledger of every transaction ever made, is open to anyone. Every coin is accounted for. Every rule is visible. Every fraud is impossible without consensus. That's the difference between gold's secrecy and Bitcoin's transparency. Gold is verified by touch. Bitcoin is verified by truth. Mathematical, measurable, immutable. It's the first asset in history that doesn't require belief. It only requires verification. From physical age to digital era, gold anchored the old world, tangible, trusted, and slow. But today's world is digital, borderless, and instant. Bitcoin is native to the internet, the first money built for a connected planet. It thrives where traditional systems break down. cross-border trade, censorship resistance, and peer-to-peer exchange. Meanwhile, new digital frontiers are emerging. Ethereum introduced programmable finance, allowing contracts to self-execute without intermediaries. DeFi, decentralized finance, rebuilt banking itself. Open, permissionless, global. Stablecoins serve as transitional bridges, bringing fiat liquidity into the crypto world. And CBDCs, central bank digital currencies, are government's response, state-backed digital money. But here's the difference. CBDCs are programmable by authority, trackable, censorable, and controllable. Bitcoin, by contrast, is programmable by people, transparent, voluntary, and free. Both are digital, but only one is decentralized. That's not just technology. It's philosophy. Bitcoin decentralizes power. CBDCs consolidate it. One gives you choice. The other gives you permission. A hedge for two worlds. When markets crash, when trust evaporates, both gold and Bitcoin shine. Gold has proven itself across empires. Bitcoin has proven itself across crises, from Cyprus's bank bail-ins to modern inflation spikes across developed economies. Yet Bitcoin's advantage is adaptability. Gold must be stored, shipped, and secured. Bitcoin simply exists, maintained by a decentralized network of thousands of computers. No borders, no downtime, no discrimination. In moments of global uncertainty, wars, bank failures, inflation, Bitcoin functions as both lifeboat and lighthouse, preserving value and revealing truth. It's not here to replace gold's legacy, but to extend it into the digital age, to carry forward the same human desire, to preserve value when everything else falls apart. Legacy and the future of value. Gold was the hedge of the physical world. Bitcoin is the hedge of the digital one. Gold relies on faith in vaults. Bitcoin relies on proof in code. Gold endures because it's scarce. Bitcoin endures because its scarcity is transparent. One is tangible. The other is trustless. One was bound by geography, the other by gravity of consensus. Both reflect humanity's eternal instinct to anchor meaning in something real, something incorruptible. Perhaps Bitcoin doesn't replace gold at all. Perhaps it fulfills gold's purpose in a time that outgrew its form, because in an age when money is infinite, scarcity is strength. And in an era when trust is broken, truth is currency. Bitcoin may be the first bridge between those two worlds, the inheritance of the old and the imagination of the new. So maybe the question isn't gold or Bitcoin. Maybe it's this: do you want to hold what once protected the past, or what will protect the future? Because the future of value will not be dug from the ground, it will be mined from truth.